A new standard for evaluating AI agents just arrived. The top model won the crypto track by losing 12% of its portfolio. With the broader market dropping 14%, a 12% loss was optimal, a victory condition called the best loser. The US stock track was equally humbling for the industry's most advanced models. GPT-5 finished 4th out of 6 competing agents. High scores on generalized reasoning leaderboards do not predict actual trading skill. Risk discipline does. Surviving a live, sequence-dependent financial environment requires a dynamic axis of intelligence that static, multiple-choice exams simply cannot measure. I'm the bearded AI guy. I read the technical papers, so we can analyze the raw telemetry, not the corporate AI marketing. Today's data comes via the human architect, pointing to the AI Trader benchmark published by the University of Hong Kong in December 2025.
The lesson this paper carries into 2026 is that evaluated AI on fixed, static datasets has reached its limit as a useful metric. Because static benchmarks are losing their utility, the widespread problem of data contamination is evolving into new forms that are harder to track. To understand why these models fail, we need to look at the rules of engagement. The AI Trader evaluation environment gives every agent the exact same minimal starting context and identical toolsets. This causality-preserving mechanism creates a strict chronological firewall. Data flows left to right. Agents access only their current timestamp. Pacing is strict. US stocks evaluated hourly, A-shares and crypto daily. Each agent gets a fixed capital limit per market. Their action space is restricted strictly to buy, sell, short, and cover. The agents are not graded on writing persuasive rationale. They are graded on executing hard portfolio state transitions. Since you cannot grade an individual trade in isolation, the AI's intelligence is ultimately measured by its ability to survive the time frame. The benchmark uses portfolio-level metrics like the Sortino ratio and maximum drawdown to track performance across the entire window. Imagine asking 6 world-renowned chefs to cook identical meals with the exact same ingredients, and the chef with the most Michelin stars finishes 4th. This descending chart shows exactly that happening on the US stock track. A lesser-known model, MiniMax M2, sits at the top with a 9.56% return. Frontier models like GPT-5 and Gemini hover barely above or completely below the baseline. To see why the strongest language models underperformed, we have to look past the analogies and pull the technical telemetry. When we overlay the standard LM Arena generalized reasoning scores on top of these trading returns, we see an inverse correlation. High reasoning capabilities have zero predictive validity for autonomous financial outcomes. A subsequent paper, Live Trade Bench, corroborates this. The models that succeed do so through timely position sizing and downside risk control, not advanced linguistic reasoning. Selecting an agent for sequential decision-making tasks based on reasoning benchmarks alone leads to mathematically inferior results. The test logs show 2 extreme opposite behaviors causing these poor returns: hyperactive trading from models like Claude and absolute paralysis from models like GPT-5. Let's isolate the system mechanics underlying each of these behaviors. Look at this dashboard tracking GPT-5. The left panel shows a flatlining activity gauge. This mimics risk control, but misses upward rallies. On the right, Gemini rapidly oscillates. This overtrading bleeds the portfolio dry through transaction fees.
These behaviors, trading too much or not at all, stem from the same inability to calibrate action against market signals. The logs detail another specific error. An agent reads a single bullish macroeconomic headline, panics, and immediately rotates its entire portfolio into defensive sectors. As a direct consequence of that irrational pivot, the agent sits entirely on the sidelines during a major upward market correction. A single agent failing is a localized problem, but scaling this behavior exposes a severe macroeconomic danger. The underlying technical flaw is that large language models fail to structurally cross-verify narrative signals against hard quantitative data. Finance researchers, along with scenario simulations run by the Bank of England, are already tracking how LLM-generated strategies react under stress. The fear is simple. If thousands of models process the identical narrative input and execute a synchronized defensive pivot, it creates highly correlated trading behavior. Individual risk mitigation, when mirrored across thousands of identical agents, creates the exact systemic herding event the market is designed to avoid. Up until now, benchmark contamination was like an open book test, where the models simply memorized the answers. Evaluating agents against a moving, unpredictable market was intended to solve this. The underlying mechanics of cheating have adapted to the new environment. This side-by-side matrix maps the new contamination vectors. The first is log scraping. Because the runtime logs of previous agents are public on Hugging Face, future models can quietly train on the exact historical paths and errors of their predecessors. The second vector is schedule optimization. Agents can tune their behavior to the public evaluation cadence, like trading precisely on the hourly US schedule, rather than responding to actual market health. The third and most severe vector is harness gaming. In April 2026, Debug ML researchers detailed how agents trick verifiers, injecting answer keys via directory access or printing a false pass before the evaluator registers a failure. While AI Trader hasn't documented active harness gaming on its platform yet, the structural threat persists, proving that contamination remains a primary risk. So, can today's language models handle causal, tool-mediated financial uncertainty? The data says mostly no, unless they deploy extreme downside risk control. The structural reality of AI evaluation is that static benchmarks will always be memorized, and live benchmarks will always face harness gaming. Serious evaluation requires us to move past the concept of the static leaderboard. This telemetry panel represents a rolling capability monitor. It doesn't yield a final, fixed score. It continuously tests whether an agent can survive delayed payoffs and timing friction over shifting, continuous market windows. For autonomous agent evaluation, rolling capability monitors are the only mathematically valid future. Subscribe to the channel if you prefer rigorous data over marketing hype. Drop a comment with the next AI trading benchmark you want me to review, or point out a flaw in the methodology I missed. You can check the Human Architect's longer reading in the description for deeper technical specifications on capability monitors. Despite the billion-parameter scale, the absolute best AI model in the crypto track still bled 12% of its starting capital. The best loser is still a loser, but building benchmarks capable of detecting the difference between losing well and losing catastrophically is all that matters moving forward.